I have a very special guest for all our viewers back home. He's a very well-known and passionate value investor, and also happens to be a friend of Mr. Warren Buffett. He has known Mr. Buffett at a personal level for almost 2 to 3 decades. Mr. Mario Gabelli, who is the CEO of Gabelli Asset Management, Gamco Funds, which rings a bell for investors back home, joins me for an exclusive chat. Mr. Gabelli, so great to have you. Thank you so much.
It's a privilege to be here and talk about stocks and Buffett.
Yes, of course, and we will talk about Mr. Buffett, but thank you very much for this interaction. This is your first interaction to an India media house, and we really appreciate it.
I'm delighted to do it.
Okay, let's talk about what do you expect to hear from Mr. Buffett tomorrow.
Well, you know, every year there are certain things that people want to talk about. For example, his succession. But Ajit was announced as being the number 2, Ajit Jain, and obviously Greg. But the things that are new are the following. Does he expect the multiple of companies that he might want to buy entirely, will they be sustainable? What multiple of EBITDA was he thinking about 5 years from now? And that's important because if interest rates rise on the 10-year bond above 3%, what impact does that have on valuations? So that's what I'd like to hear. The second thing is, why did Warren Buffett all of a sudden allow things that he wouldn't do in the past, like buying Apple, a technology or as a business or a consumer products company? Also, why would he want to buy airlines, which he said in the past, you want to become a millionaire, start with $1 billion and buy an airline because you're going to lose your money.
True.
So why is he doing that? And then obviously there are certain things going on with regards to corporate taxes, with regards to regulation that he'll be commenting on.
Yeah, but you've also, I read a piece where you spoke about, you want to hear from him about the future of cable television. You want to hear about healthcare costs. What's his opinion on all of that? Is that also part of...
I don't think Buffett is going to talk about cable television. I don't know if he cares about that, but Todd and Ted, who run his public money, Ted has been very important in doing some work in the broadcasting area. Todd has been very important. So that if those investments show up, so when you look at his holdings, he has 200 billion US, and the top 5 names are about 100 billion, 120 billion of that. And then below that you have a lot of names, but part of those are Todd and Ted buying them, the 2 other investment gurus that he has.
Yeah, exactly. And the interesting part about their investment philosophy is that their investment arm has just now invested in Teva, which is an Israeli-based pharmaceutical company which is in the generics business. So when you're talking about healthcare costs coming down, the generics market is the big market to focus on. Do you hope to hear something more from him regarding whether he's excited about that space?
That's a very good question, because Warren Buffett in the past said that medical costs in the United States are rising, and they become, he used the word tapeworm in your body, eating away at the American system. So he and Jamie Dimon, who's the head of JP Morgan, and Jeff Bezos, who heads up Amazon, have come together to look at healthcare. And how are they going to address this? This is going to be a question asked tomorrow, which I did not point out.
No, and the reason I ask you this question is essentially because in India we have some great generic pharma companies which are supplying to the US.
Yes.
And I was just wondering, okay, when will Mr. Buffett look at India and look at opportunities there? He's sitting on $135 billion. When is he going to make his next purchase?
He would, I assume that one has to bring it to his attention, and it will happen. And clearly with your comment about generics and Teva, there are plenty of companies in India that he should focus on.
Oh, absolutely. I want to talk about the fact that, right now the world is squarely focused on interest rates being a big risk for the current market environment. This has been a 10-year bull market, and everybody's worried about what will lead to the tipping point, what will essentially cause the tipping point for the markets to come off. They are fearing a correction which hasn't quite come yet.
Yeah, but the volatility in the market is what I call the, in quotes, old normal, close quotes. In other words, we always had that. It's only been the unusual events of the last 12 to 18 months until February of 2018 that the U.S. markets were, not volatile. So from my point of view, price could be too high, speculation could become rampant, there could be a geopolitical dynamic, but also if interest rates go too high or if there's a tariff war that people are uncomfortable with. So it's the loss of confidence that you can't expect, and that can happen at any time. From my point of view, you know, if interest rates are 3.5%, 4% on the 10-year U.S. bond, that's not so bad.
That's not bad. And
No.
we've seen that actually, you know.
If it comes too quickly, however, that's bad.
That may be bad, because I remember 4 years back when, you know, the yield, I think that maybe 3 years back when the yield hit 3%, world markets went into a tizzy. But we haven't quite seen the same reaction right now, which just tells you that maybe the markets have taken this on board.
The U.S. Treasury bill is about, for 6 months, is almost 2%. The German Bund and the Japanese currency equivalency are still not positive.
Not there, yeah.
So we have to make some adjustments. Stepping back, the Federal Reserve in Europe with Mario Draghi, with now Janet Yellen and her successor Jay, have put $4 trillion or 10 trillion on a global basis that they were withdrawing. So that's going to happen. And the question is, do we have enough economic stimulation to provide growth while this is going on? And so, work in progress. You have to continue to think about the details of how that works to see how it works out. I'm reasonably comfortable.
You're reasonably comfortable, Mr. Gabelli, but how do you see the road ahead on rates? Because so far it's been very measured. You know, the pace of hikes has been very measured, very well communicated to the markets, well documented. If things change on inflation, given what's happening with oil prices and core inflation also picking up as is expected, you know, and the whole outlook on rates changes just marginally so, would that make you a bit nervous if rates were to go faster than currently higher?
Well, if they go faster, when I look at the world of my companies, if you have global GDP with established countries growing at 2% or 3%, and the rest of the world growing 5 or 6, like India, even faster short term.
True.
If you put it all together, what happens to the inflation part of the revenue stream? Will companies be able to pass along price? And will that have an impact on their multiples? But make it simple. If rates go up too fast, it's a problem. But it's not only rates, it's how fast do they take money out of the system. So they put a lot of money in 10 years ago, and now they're pulling it back. Draghi has to do it in Europe at some point. We're doing it in the United States. And so that's what we look at. In other words, monetary policy was a tailwind. Now it's a headwind. And fiscal policy and economy has to be supplying the balance. And we have that in the United States. And we have it okay in Europe with all of the problems. You know, the Russian tariffs, the Chinese tariffs, and those are issues that we have to work our way through.
But how serious are those issues? I mean, you know, I was hearing you earlier this morning, and you're talking about geopolitical risks always being on the market's mind. You know, it's either North Korea and the United States, it's Russia and the United States, it's the Middle East. There are always geopolitical issues to contest with.
I agree. When I was in grammar school, we used to say, go under your desk to practice in case there's a nuclear bomb exploding. So, you know, we always have these risks. The market has a world of worry. We hope we survive as a country, as a world, but that would be a surprise on the downside.
But to your mind, I mean, aside of geopolitical risks, because they are unpredictable, what risk do you foresee that can really derail the markets from here?
A loss of confidence in a political system. A loss of confidence, if the 10-year bond goes up too high, it would cause some concerns. But you also have a new money flowing into the stock market through a vehicle that's untested, electronically traded funds. You don't know how investors and their surrogates, those that put them in this, what will they do, and when they withdraw the money and the money comes out of the same stocks. That I like, I mean, I like to buy stocks cheaper, so
Yeah.
that would be good for me.
Going to that, ETFs, right? Mr. Buffett loves ETFs. He says go the passive way. Where does that leave mutual funds? Where does that leave hedge fund managers? Where does that leave active fund managers?
I think Mr. Buffett is a historian of economics and returns. So he looks at the United States over the last 110 years and said, if you were in the United States in the year 1900, we had wars, we had inflation, depression, crazy presidents, good presidents. The market grew 6-7%.
Yeah.
Over the next 20 or 30 years, he thinks that GDP in real terms in the United States up 2.5 to 2.5%, inflation higher, margins maintained.
Yeah.
So if you bought an ETF, you would make 6, 7, 8, 9%. But more importantly, if inflation ever took up, you know, over time, the pricing power of your assets would be preserved.
Yeah.
So that's why for the individual investor who really doesn't know, he says long term, buy an index fund. We think if you bought an index fund in the United States, like an S&P 500, you'd make 6, 7, 8%. For the last 40 years, we have compounded clients at 16% with no leverage, and in the United States, tax
So
sensitive.
do you have disagreements with Mr. Buffett on this?
No, we're both in the same. For certain investors, buying an ETF is appropriate.
Yeah. So it's a profile of the investor.
And if you're not in the market and you're psychologically buying when things are hot and selling when things are bad, you're better off just holding an ETF.
Yeah. The reason I also ask you that is coming from emerging markets. We've seen how active fund managers, and I have a completely unbiased view here, but we've seen how active fund managers have been able to take advantage of market inefficiencies to outperform the index by a whole big margin. Do you think that it's also a case of measuring the profile at the point in the market cycle that an economy is in?
Well,
so
there's
for
an
the
element of that, but on the other side, I'm not as comfortable I can address which markets we're talking about. I'm looking at the U.S. capital markets, and I can't address the Indian market. I have money in India myself personally by buying a mutual fund called the First India Fund.
Okay.
And I have colleagues, some grew up in Delhi, some grew up in Bombay, some grew up in Calcutta. You know, so we have individuals that work for us from different parts of the world. One individual, in fact, spoke 6 languages with Indian dialects. So from my point of view, it's really how can you handle your money as an investor when you're looking at the markets going down, and how do you do when the markets go up? Do you get more excited? And you really have to have a steady course over a period of time. Now, India's economy is probably 3.5% of the $85 trillion, and that's terrific growth. Modi is doing a terrific job. We hope to put it together, and it's wonderful.
Do you hope to invest more in India? Do you hope to?
No, here's what we do. We don't invest in Germany. We don't invest in Russia. We don't invest in Italy. We don't in India. We buy companies that we like with businesses that we like. For example, if you drink anything in the world, wine, water, beer, soda, booze, we follow those companies. So we like countries that are having a rising disposable income. And so what beer company? Do we buy Kingfisher? Who owns it? Do we buy a beer company in China? Do we buy a Scotch manufacturer? So that's what we look at on a global basis. Because do they have pricing power? Can they raise prices if inflation goes up? What has the consumer has more money? Where will they put their money to work? And that's what we like.
Okay, before I come on to talking of the sectors that you really like investing in, whether India and other emerging markets hold ground there, is oil a worry? Do you think oil prices moving higher from here, is that a concern?
There's 1.2 billion cars on the road in the world. The average car gets 25 miles on a gallon. So in the United States, as an example, where we have 250 million vehicles, we consume 140 million gallons of gasoline. So if it goes up 30 cents a gallon, we're taking a lot of money out of the system. In the United States, they have technology called fracking, and you have solar and you have wind.
Yeah.
But on balance, it takes money out from the consumer, and they're not spending it. So it has a drag on the economy.
Yes.
Not as bad as certain countries that are importing a lot more of their
True.
oil. On the other side of the coin, the Saudis and the Russians are really, OPEC has 96 million barrels of production. We're consuming 97 million. The balance is there. Will they step up production, or are they waiting for the Saudis to float their stock? There's a lot of theories going around. From my point of view, the equilibrium, based on what I talk to people, is probably $60 to $65
Okay,
U.S.
that's okay.
U.S. Not Brent,
okay.
not West Texas,
Yeah.
not Brent.
Right. And so roughly that's the range that you see on oil.
But it's higher now, and if there's a problem in Iran, you know, if there's any disruption in supply, like is occurring in Venezuela, that's always a challenge.
Isn't it the hardest market to predict?
Everything is difficult. That's what we get.
Yeah.
We're overworked,
Yeah.
and we're overpaid, and we intend to stay that way.
Yeah, of course. Let's talk about the sectors that you love. Now, you love media companies. You've been a prolific investor in media companies. How do you see the opportunity in the media space going forward? There's a lot of M&A happening here in the United States. There's a fair amount of, from India as well, fair amount of scope and scale for the media sector. How do you size up the opportunity for the media space going into the future? Because digitization is clearly the next big wave for content creation.
The United States has 330 million people. The world has 7.5 billion. Mobile phones, the smartphone, is now in over 4.5 billion people. The notion of digital communications is helping everyone. So to the degree that content can be produced in Bollywood and has distribution around the world, that's attractive. To the degree that you have a company like Eros that has a lot of library, kind of something I pay attention to. To the degree that I have wireless telephones, to the degree that I need speed with cable, we follow that. So we cover those industries globally. And that's because of the globalization of the marketplace. So when I look at Viacom, they have a company called Paramount, but they also have distribution in Argentina, England, and India. And so they own these operations. So this is a terrific asset. And what's going to happen in the next 20 years? Now, certain countries like China limit the amount of movies that come into the country. You want them to open that up because we own the content. So we like everything to do with that.
Okay. In emerging markets, what I know that's not your domain of expertise, but even so, over the last few years, the profile of emerging markets as an asset class has evolved, has changed. Many believe that they're becoming a class of their own, which is comparable to how developed markets look like maybe 2 decades back.
Yes, I agree.
Right? So how do you look at emerging markets today?
Okay, when I step back, my mother was born in Italy. My father went to Italy from the United States when he was 2 years old. We had no money. So how do people create wealth and create a vision for themselves? The free market system with all the problems, the rule of law, and meritocracy. How do we convince everyone that they can work hard, and if they're smart and they work hard, that maybe they get lucky, but the system should allow that to happen. And so that is an important part of the way we look at markets around the world. When I look at India, and I look at the number of people there and how the growth rate is occurring, and you break down the local barriers that occurred, that is very encouraging.
Right, but again, there's so many emerging markets, right?
I know. I'm not talking about Ethiopia.
Yeah.
Okay?
So how do you profile India and China, because they are the high growth markets within EMs? India, of course, from being an oil importing nation, that's a bit of a macro worry. But other than that, India and China, given their growth prospects, how do you profile them within the EM pack?
Look, the individuals that I talk to, which I don't do, will say, here are the banks that are privately owned, that is publicly owned in India. Look at their growth rate versus the ones that are in part state owned. We don't do that. So we're not saying we want to invest in India. We want to invest in intellectual properties. We want to content distribution. So do we want to own a satellite distribution company in India? Do we want to own a cable company? Do we own a wireless company? And that's what we'll look at over time. And the fact that, you know, it's an emerging market with each 1% change in disposable income, you know, we pay attention to that, but that's not our strength.
That's not your strength. Okay, I give it to you. But even so, you know, we are just drawing towards the close of this interview. So maybe a couple of thoughts on how you see investors in a market like this being able to generate alpha. That's where my question came in for emerging markets. But do you think on a differential basis, given that at a policy level also there's a bit of a divide between EMs and DMs, that there could be an opportunity to generate more alpha in emerging markets?
If I am 10 years old and I grow up to become 20, I've increased my age 100%. So the growth rate of investments in emerging markets, if you find the right companies, but you know, you can find the right companies in developed markets. So we like small companies because no one else follows them.
Yeah.
So we're not buying a basket of Indian stocks, we're buying specific companies. We're buying them in China, specific companies. And that's what we do. And we are what they call stock pickers with a value bias. And we've been doing it for 50 years, and we're going to do it for another 50 years. Warren Buffett started in 1950 when he went, before that, when he had a hedge fund, but he went to Columbia University, which is where I'm on the board for the last 35 years.
But how hard is it to find value in the current market, Mr. Gabelli?
It's not complicated. It's complicated to buy a lot of money to work. Like Buffett has a public portfolio of 200 billion US.
Yeah.
So for him to buy all the little companies that I buy, they can't do it. We have over 5% of 120 companies in the United States that we own. And we follow them, and we talk to the management, we talk to the competitors, and we go to meetings everywhere in the world for them.
But then what will you say to people who are saying, okay, generating supernormal returns or above average returns is getting harder for the market given value?
I agree. When the market, over the next 20 years, next 10 years, the market, if you bought a global index fund like Morgan Stanley or an S&P 500, you're going to make 7, 8, 9%. So to the degree that we compounded at 15.3% net of a small fee, we don't have incentive fees. I don't think we can do that over the next 30 years from today. But we're still going to be able to outperform that market because we're looking in places where the world is not looking.
You know, at the conference today, you said pray for a correction. A 40% correction is more than welcome. Do you see that coming by anytime soon?
Well, if the Dow Jones is the market and it's 25,000, 40% down is 10,000 to 15,000. You know, it could happen. But that's yeah, right. If I would be rich if I knew when.
No, because people are, every time there's a hint of a correction, you know, everybody starts comparing the fall to 2008. It's almost like 2008 has scarred markets forever.
I was there in 1900. In 1893, there was a big correction in the United States. There was one in 1907, 1919, 1929, 30, 1937. In 1957, you had a problem. In 1961, when President Kennedy was in, you had a problem. 1970, 71, 2, 3, it was terrible. So I've been there through all of these markets.
So 2008 looks like just another story.
Yeah, that's it. And this one was by financial. Wall Street got too leveraged, and you have to constrain the financial system. The free market works, but sometimes you have to
readjust.
Put you know, an electronic fence around some of the issues. Thank you very much. You asked great questions. I appreciate your interest in what I do.
Thank you very much,
and
Mr.
hope
Gabelli.
to meet you in your home country sometime.
Oh, absolutely. We would love to have you in India.
I've only been there once a few years ago.
You could find some very fascinating opportunities in India, I can assure you.
My son, who worked at Lehman in London, wants to open an office in Mumbai. So
great.
Yeah.
We would love to have you in India.
Thank you.
Thank you very much, Mr. Gabelli.